Since October 2016, the average single-family home price in America has skyrocketed 77% from $202,000 to nearly $358,000 according to Zillow's Home Value Index. What used to be the achievable American dream has now turned into a nightmare for most young Americans. Now factor in rising rates and this nightmare becomes even more lucid and powerful. Back here, you could secure a typical 3.5% mortgage on a reasonably priced home and pay under $1,000 a month. Today, with rates hovering near 7%, this typical payment has skyrocketed to nearly $2,340 per month. This frustrating reality is not just problematic financially, it's quite literally reshaping the fabric of society, shifting cultural norms, demographics, and standards of acceptable behavior. For plenty of young families, the only way to buy a home today is to receive significant help from parents. Take, for example, this scenario. If you use Dave Ramsey's How Much House Can I Afford calculator, you can see that to afford a typical home today, which according to Zillow is $357,000, you need about $71,000 down and you'll need to earn about $12,000 a month in after-tax take-home pay. That may sound insane because it is insane. According to most sources, only about 5% of American households earn that much, and when you factor in the typical home buying age, that number drops to about 3%. So according to this reality, average American homes have been essentially reserved for doctors, successful lawyers, business executives, and most importantly, people with large inheritances. To afford a home under Ramsey's rules, you essentially need to be wealthy or have financial support from affluent parents. Or maybe we all just need to wait for the right time. Since 2009, the real estate market has experienced a nearly uninterrupted upward trend, fueling speculation that we're in a massive bubble. Many believe this bubble is poised to burst, potentially bringing down both housing prices and interest rates. We know that the last time home prices began spiraling out of control, this happened. Home prices in many areas plummeted. In the Las Vegas area, for example, home prices collapsed by over 60% on average, with some neighborhoods experiencing even greater losses. While the recession devastated many financially, it also opened the door for young families to purchase affordable homes in some of America's most promising cities. So the big question on everyone's mind, especially since the 2020 craze, is should I wait to buy? Is this basically going to happen again? Well, to answer this question in today's video, we turn to Warren Buffett. Warren rarely makes any comments on housing, but during the 2002 Berkshire Conference, he had this to say about the market. For historical context, the housing market in 2002 was in a somewhat similar position to today. Prices were climbing and many were under the impression that a bubble was brewing. Take a listen.
I'm Bob Klein from Los Angeles. I wonder if you could give us a glimpse into your investment process, the way you approach looking at a particular industry. And I wonder if you could use real estate as an example. I know real estate hasn't been a huge part of Berkshire's portfolio over the years. And I wonder if that's because you view real estate as a commodity business, or if maybe the cash flows from real estate tend to be more predictable than perhaps from some other industries, and thus it tends to be less likely to be mispriced and therefore less likely to find terrific bargains in real estate. So
go ahead.
So just wondering if we could, if we were watching a discussion between you and Charlie hashing out the merits of real estate, how it would go.
Well, it would go like all our other conversations. He would say no for about 15 minutes, and I would gauge by the degree to which the motion he put into his nose whether he really liked the deal or not. But we both had a fair amount of experience in real estate, and Charlie made his early money in real estate. The second point is the more important point. Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way, and they didn't know what the hell they owned and all of that sort of thing. I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that. But under most conditions, it's hard to find real estate that's really mispriced. But occasionally there have been some, there could be big opportunities in the field, but if they exist, it will certainly be because there'll be a lot of chaos in real estate financing for one reason or another. We've done some real estate financing, and you have to have the money shut off to quite a degree, probably to get any big mispricing. That kind of thing could conceivably happen, but it's unlikely.
So there you had Warren say some very important things that we need to make note of. First is that real estate is not a commodity. He thinks it tends to be accurately priced most of the time. Under most conditions, he says it's hard to find real estate that's mispriced. And he also states that you need to have the money shut off to quite a degree to get any big mispricing across the board. So essentially, according to Munger and Buffett, the real estate market for the most part is always correctly priced, even if it appears high, and really the only thing that can get you large fluctuations in deals is the financing portion. What he's essentially saying is that for home prices to drop significantly, access to financing must become more restricted. The vast majority of homes in the United States are purchased with a mortgage. According to most sources, nearly 80% of all home purchases involve this type of financing. Looking back to 2002, we can see that banks began loosening their financial restrictions, allowing nearly anyone to qualify for a home loan. However, when financial conditions tightened significantly in 2008, it created massive downward pressure on home prices. This dynamic is evident when examining mortgage originations, which represent the total dollar amount of loans approved each quarter. For instance, in Q3 of 2007, mortgage originations reached nearly $701 billion. By 2009, this figure had plummeted by 57%, closely mirroring the sharp decline in home prices during the same period. Now, you might compare this to 2021 and argue that we saw a similar, if not more dramatic, situation. In Q2 of 2021, approximately $1.2 trillion in mortgage loans were approved, but by Q1 of 2023, this number had more than halved, yet we didn't see a corresponding shock in home prices. One key reason is that banks have maintained disciplined lending practices. Unlike the early 2000s, banks learned from the 2008 recession and have upheld strict residential lending standards throughout the 2020s despite massive fluctuations in loan volume. They have not relaxed their criteria to accommodate low-credit, high-risk borrowers, which have kept default rates low and the market stable. As a result, even with a significant drop in mortgage originations, home prices have remained resilient. Today, while it might seem far-fetched, the market remains relatively fairly priced, largely because lenders have maintained their discipline. For a significant crash to occur, we would need a combination of looser lending practices and heightened speculation. Without those factors, the market is likely to remain stable. Even if we were to experience a crash similar to 2008 with a 28% decline in prices, current valuations would still sit above pre-2020 levels. This highlights how much growth has occurred in recent years. Waiting for a return to pre-2020 prices becomes increasingly unrealistic as the market's growth has far outpaced any scenario that would make such a wait worthwhile. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know how you feel about the housing market in your city in the comments below.